You're watching Stock Watch. I'm Zanati Kuma, and joining me to unpack your stock-related questions today are Ricus Reeders from PSG Hole-in-One Ruimsig and Mutooni from Sanlam Investments. Be sure to send your questions through via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. It's good to see optimism in the markets today. Even the Rand had a little bit of a makeover, just like this new hairstyle that I've got on today. Back above 18 Rand 30 against the US dollar after hovering about 18 Rand 59 against the dollar yesterday. So seeming that nerves have calmed down. But usually when the gold miners are up, it means that nerves are heightened. Let's actually start with what happened with gold today, Ricus. What is responsible for that? Is it to do with the price, or maybe just some of the numbers that we've seen coming out of these gold counters?
Well, trying to say what drives the gold price is a fool's game. In the short term. Long term, it's always the opposite as to what happens with real rates, because gold doesn't have a return in itself. But I think it's just what certainly has been driving gold is rumors of central bank buying and quite a bit of we haven't quite seen the public get the gold fever yet, but that's there certainly has been physical demand. But at the moment, it's just people taking a look and saying, is the world going to hell in a handbasket? And that's what's driving it. It's pure sentiment, and as an asset class, it's unaffected by anybody else, because there's no counterparty when you actually buy physical gold. And that's the interesting bit. It's a demand for physical gold, not paper gold in the form of an ETF.
Well, actually, there's been a debate on what you should go for to take advantage of the higher gold price, whether you go for a physical gold, a gold ETF, or gold miners. And of course, some people have said that it is risky going for the gold miners because other than just looking at the gold prices, you also have to look at their operations. But Gold Fields, which has been one of the counters where people had been worried, particularly in the first half of the financial year, that maybe their operations are not taking advantage of the gold price, seems to have actually improved, where now they are trying to catch up to that. Roy, what did you make of Gold Fields' numbers out today?
Well, the thing is, yes, they're definitely improved. But if I go back to your original question, it's two very different things when you look at gold versus gold companies. First of all, gold companies tend to underperform the gold price. There's the issue around operating entities and everything. And then I think more interestingly, when gold is trading as a safe haven, people want the physical stuff that they can put in their bottom drawer to conserve wealth. So there, you're not speculating, and you're not looking for leverage on the upside. What you're just saying is, this is my level of wealth right now. The world is a very uncertain place. Maybe inflation is getting out of control or beyond levels I was expecting. Let me just hold on to what I've got. And that's the purpose that gold has served over time. So with the companies, sometimes they do well, sometimes they do badly. Sometimes they produce a lot, they high grade and all of that. That is looking for leverage. That tends to happen in risk on good times and that sort of thing. So I think the investors need to be very clear as to what they're looking for.
But in terms of Gold Fields, Ricus, any thoughts there on what they were able to produce? I did see, I think at some point that share price was up about 9% during the day.
Yeah, if I can just quickly agree with Roy there. Gold mines are a wasting asset. It's for trading. It's not for investing. Physical gold is something else completely. As far as Western areas are concerned, they had some problems at South Deep, which is locally, but that seems to that difficulty is being solved. And the Chilean operations have, after experiencing some very bad weather, strangely enough, I mean, they're high up in the Andes, and they had a very cold spell. That seems to have gone better as well. And I also think they are getting, they're solving their problem with chinchillas. It's a small
Yes.
type of rodent, can I call it, that's under threat, and they had to relocate these guys and change the whole mining plan as a result of that. And then obviously the gold price in their favor, even with an increase in costs. If we're looking at what the gold price is doing, that's just money straight down to the bottom line.
All right. Well, let's get into some of the questions that have come out, kind of sticking with gold, but also diversifying into other metals. There's Sibanye-Stillwater. There's a question here. Should I increase my holding in Sibanye or should I sell? I actually remember, I think it was a few weeks ago, the Sibanye share price actually went up quite a bit. This is maybe one of the more unloved ones in that commodity space. Roy, Sibanye, hold or sell?
So Sibanye is interesting in that there's a few things happening around them. But first of all, the handover from the founder to new operational management means that maybe the company takes a little bit of a different direction. Maybe they're not so acquisitive. Maybe the operations will get a bit more attention and may start improving. You may see a more organized rollout. But at the end of the day, it's marginal gold mines that have a limited life, and the platinum side and all of that speculative stuff, plus a whole bunch of debt. So at a time when people are concerned about where the world is going, growth is not very clear. This is it tends to lean on the more speculative side. So I'd advise the investor probably to think about it in the context of their portfolio. This isn't the time when you look at stocks such as these to double or triple or whatever. You need to understand what your risk profile is and how much of this you want to expose yourself to, because it's a really geared play on good things happening and the market working out in their favor.
Well, yeah, I mean, nothing has looked pretty for Sibanye, Ricus, and I'm wondering, because the viewers is asking if they should sell now. Is it not a little bit too late to sell now?
Well, it depends on whether he thinks he can use the money better somewhere else, and I would suggest that he can, even if he wants to remain in that sector. As Roy said, these guys they've got a huge pile of debt. They've got problems with their American platinum group metals mine. The gold mines sort of saved the day a little bit for them in the latest results, and they've had a lot of brown or greenfield projects on the way as they try and diversify into other metals. But we were talking about gold, and in as much as gold shares are a trading vehicle, so are platinum, and platinum at the moment is not really doing anything. So if you get a huge increase in palladium and platinum spot prices, it will bode well for Sibanye, but it will do the same thing for other platinum shares. And at least if you're not in Sibanye, you're not sitting with that huge risk as far as debt is concerned.
Well, gents, let's go into the gold of retailers. I'm sure you know which company I'm talking about, and that is Shoprite. Also, viewer asking if I should increase my holding in Shoprite or I should sell. And I'm guessing, obviously, the selling would be that I have earned so much money on this. Let me just take some profits off at the table. But I'm guessing also maybe increasing your holding in Shoprite may not be a bad idea, Roy.
The way I like to think of these high quality companies that tend to grow over time is that your entry point is incredibly important. So they've done well. They've executed incredibly well with 60/60, growing space while Pick and Pay was struggling and everything. But they're at an elevated multiple. So what you need to ask yourself is, am I willing to pay a higher multiple for this? Do I think that at some stage it will trade at a higher multiple? Or does the earnings growth profile bail me out? If you come in at a high earnings multiple, you need significantly higher earnings growth for you to realize your return intentions. And that's the thing you need to be careful about. So in difficult times, in times of uncertainty, yes, you want these good quality businesses that have solid franchises and strong competitive positions, because your downside is largely covered. But you also have to get in at a good price. You've seen the price of Shoprite drifting down a little bit, and that's probably because the multiple was stretched. And as it comes down closer to its longer term average, and I don't know, that could be 16, could be 17, could be 18. Maybe that's a point at which you can buy and earn a normal market return. But if you're going to buy one of these stocks at 20, 21, 22, your return expectations should not be particularly aggressive, I would say.
Maybe, yeah, as you say, the fact that it has been trending downwards, maybe it has been overstretched. But would you not say that, Ricus, this is maybe an opportunity for somebody who's not in the stock to go in, or for someone who is holding the stock to also maybe take a bite of more of it?
Its time will come, but as Roy said, at what price is that level where you're okay buying into it? One way to take a look at it, as Roy said, is to say, well, what's the average PE or over a number of years, and how far above or below are we? And you can time it that way. Otherwise, you can take a look at a graph, which I do. And let's see, Shoprite's down about 13% from its all-time high. Possible downside, another 10% to around about the 245, 240 level. And it would become interesting from a technical point at that price. Do I think one should hold Shoprite in your portfolio if you want to have a South African retailer? Absolutely. They've been executing very well, and they will remain at a high-ish price earnings because the market ascribes a premium to that price because they do so well. The time to get worried about these high PE stocks like Shoprite or Clicks is another one, for example, is when they start having a PE that's comparable to the others, because that means they've lost something as far as their growth prospects are concerned. It sounds counterintuitive, but I'm comfortable with high PE companies remaining high PEs. It's when that PE starts dropping over a long time that you think, what's the market seeing as, or what's the market looking ahead for as far as the earnings growth is concerned?
One thing South Africans don't want to be brought on is the VAT of increase of 2%. Let's get to, I mean, I was looking at the retailers yesterday, and, you know, counters like Truworths, TFG, even Pick n Pay, even today, actually, they were under pressure. And Ricus, I'm wondering if the possibility of a 2% VAT increase had anything to do with that, and maybe if it's shifted your view on the growth prospects of the retailers if this is implemented?
It had everything to do, I think, with the sharp drop we saw both yesterday and today, as you correctly pointed out. It's concerning that government's only idea of running government is by increasing the tax on spending. It's not value-added tax. It's tax on spending, and that in itself just tells you it's going to kill the economy if you pay a tax on stuff you want to buy, whether you're me or anybody else in this country, rather than doing the fairly obvious by cutting government expenditure, doing the same with less. Has it changed my view on the consumer? Not really. It just means more pressure on the consumer. And we were just talking about Shoprite and that going, you know, it's been going down because of pressure on consumer. There's now further pressure on consumer. It's going down further. So all these retailers are just adjusting to that. Never mind the fact that we also had some retail sales numbers out yesterday, and that also showed a month-to-month drop, and that didn't help either.
Well, it was quite interesting. I don't know if maybe I just didn't look deep enough, but I saw that the clothing retailers were actually the ones that were hit the hardest. Of course, Pick n Pay was there, but the clothing retailers were actually the ones with the most losses. Roy, would there maybe be a difference in how you're looking at the different retailers?
Think about it this way: the consumer has a fixed wallet, pretty much. I mean, I don't know anyone who's seen more than 2, 3, 4% wage increases over the past few years, unless you're a civil servant, of course. I mean, they've had some good, generous above inflation increases. The rest of us haven't. If you increase VAT, then your ability to spend gets contracted by that amount. So you're going to have to reallocate. And what gets hurt the most is discretionary stuff, clothing, shoes, going out, and all of that. So for sure, I think that was the market's way of repricing, because 2% is a lot.
Yeah.
And as well, remember, we're at the bottom of the inflation cycle. If inflation starts rising, something that was 100 rands maybe now moves to 120, or I mean, for argument's sake, say moves to 110. And then you add an additional 2% of that. So your absolute increase is that significant. So you have to ration your money across a lot of stuff that you consider essentials and stuff that you consider discretionary. So it's got far-reaching implications. I mean, for me, the easiest thing here, or rather the more rational way to think about this thing was actually look at where the spending is. Cut back on government spending.
Yeah.
Let the people keep spending. Let the people keep involving themselves in the economy. If you consider interest rates are not going down fast enough, okay, so that's already one thing that takes away from discretionary spending. And then now VAT goes up. That's a double whammy on the consumer. That's what the market is pricing.
Yeah. Well, gents, let's go into paper. Impact, they released their trading update yesterday while we were all consumed with the budget. The question goes, does a packaging consolidation make sense in this low growth environment? With Caxton showing it can grow earnings in this environment, would a tie-up with Impact make sense for Impact shareholders, with Impact potentially benefiting from Caxton's cost control and broader operational synergies? And that trading statement from Impact did not look pretty. I think about more than 30% decrease in their in their hips. Ricus, paper consolidation, would that be a thing, a good thing?
With Caxton, well, they first got to play nice with each other. I don't think there's any, we're all aware of the various allegations and mudslinging that's been happening between Caxton and Impact. Obviously, it makes sense if they can work together, but it doesn't make, it doesn't help if it makes financial sense and you don't have unity and in governance. We all know what that happens when that happens.
Yeah.
But is packaging per se locally something to be in? Royce just told us about how even the possibility of an increase in taxes is influencing sentiment towards consumer spending. So why do you want to be in a packaging company that's local? It's the kind of company you want to be in when the economy is firing on at least one or two cylinders rather than none.
Even global, because Mondi came out with numbers today, and I didn't see where the share price ended, but at some point when I was looking during the day, it was down almost 5%. And Mondi has really been the one that's been really, really punished in this kind of environment, not seeming that things are improving. They said that at the beginning of the 2020 the financial year, that it seemed there was going to be a recovery, but things quickly turned around and there was more pressure in trading conditions. Is there just no light at this point for Mondi, Roy?
No, this Mondi is a great quality business that everyone likes from a management perspective, capital allocation and everything. But like Ricus says, it's exposed to general economic growth because it's packaging, and packaging, demand for packaging grows when people are buying stuff and sending it all over the place. And you're not seeing that. You're not seeing a significant economic recovery, particularly in the strongholds in Europe, in places like Europe. So they can be as good quality as they want, but that top line doesn't come through. Your ability to price doesn't come through. So earnings growth is very hard to get to. So these sorts of stocks are very geared to where the economy is going. You've got to see global growth picking up relatively aggressively. And early in the cycle, you get into them because then what happens is they get higher capacity utilization, pricing comes through, and earnings growth comes in. So yeah, it's not a surprise that the markets shied away a little bit from this one.
Yeah, I'm going to give each of you a stock. So out of the results that came out today, Roy, you Blue Label, and Ricus, AECI, I think you have picked it as your stock pick. It did surge by about 7% during the day. No. Why do I think you've chosen it as your stock pick? Any views on AECI?
Well, the main narrative behind AECI is a lot of spend over the past number of years on capital projects and very little earnings from those. So now they have this big plan to go and simplify the company, getting rid of companies that are making a loss, looking at their costs, trying to turn around their operations in Europe, which is difficult because, as we can see with Mondi, Europe is not exactly a growth vector at the moment. So in the release today, we didn't yet see that turnaround in earnings coming through, but the narrative remains the same. We are still in a turnaround situation, basically.
So short-term pain for long-term gain. Quickly, Blue Label. Yeah, hopefully.
Blue Label.
Yeah.
This Blue Label is basically the story of how they're slowly increasing the economic interest in Cell C, and how the Cell C operational improvement is coming through. The fact that the EBITDA, the guidance of the feel for what level of EBITDA that Cell C can generate is actually stepping up. So it looks like it's a plan coming into place. It looks like the debts are going to get paid off between the two of them. And if they get approval to consolidate, then we will see a different presentation of these numbers, which I suspect will look a whole lot better than the standalone with all the SPVs and all the intercompany debt. So I think they're progressing. It's been a long journey, but there's clearly light at the end of the tunnel for the combined entity. So I think the market sold off a little bit, but the numbers are quite complicated.
Yeah.
I mean, from that perspective.
But Shem, it did reverse a lot of those losses during the day as well. Let's get to your stock pick for today. Your stock picks. Ricus, what are you choosing?
It sounds boring, but it's Berkshire Hathaway. The reason being that I'm still worried about the American market and by default the rest of the world stock markets, because as we know, if the Americans crack, we're going to get hurt. I'm not normally a contrarian because contrarians are right only 20% of the time. I like following trends, but in this case, Berkshire itself is contrarian. They've got about 25% odd of their investments in cash. That's hugely defensive, and I like that. And one of the reasons for that is in comparison with other asset managers, according to the Bank of America, who are the highest invested in markets in the past 15 years, with less than about 5% of the holdings in cash. Berkshire is the contrarian to that. And the last time we were looking at this kind of investment level by other asset managers was in 2000, and it took 13 years for the S&P 500 to exceed the S&P 500 index point at that time in 2000. I think we're in a risky market.
All right. Roy, what are you hanging your hat on today?
Even more boring is Telkom, but I think Telkom is cruelly understated. I think they have probably the best data network, the cheapest cost data, and the pricing gap between them and the incumbents just means that they can't be caught. And the thing is, they're nicely positioned for those 15 to 20 million people who are still on 2G, 3G. When those people upgrade, the place they want to go to is data with cheap handsets. Telkom's the one that's best positioned right now to take all of those, and I think you'll see it in their margins and in their cash flows over the short to medium term. Their debt won't be an issue. By the sale of SwiftNet, they'll probably clear up a lot of that. So this is a business that I think over time will start looking a lot better than people remember, the old Telkom, and will reward us, most likely going back into a dividend-paying position over the next couple of years.
All right. Well, thank you so much for your time and for your analysis today, gents. That is all for tonight's Stock Watch. Thanks to our guests, Ricus Reeders from PSG Holland-One Ruimsig and Roy Mutooni from Sanlam Investments. Do note, Stock Watch will be live at 12:30 p.m. tomorrow. Be sure to send your questions early via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Up next, though, the close. Stay watching.